Vanguard has recently come out and said that investors should only have somewhere between 30, maybe 40% of their portfolios allocated to equities. That is for an investor who would normally otherwise be 60% equities. So according to this, most investors are being way too aggressive in this current environment. I want to break down some of these latest studies and commentary they've made and think about whether you should make any changes to your portfolio, especially if you're at or near retirement. Now, my name is Scott Caufield. I'm a CPA and CFA charter holder and the founder of Sophos Wealth Management. The big headline that Vanguard came out with said that instead of like 60-40 portfolio, most investors should be more like a 30-70 portfolio. Now, this comes out of their time varying asset allocation. This is a TVAA model that they come out with. And what they do is basically say for an investor who should be 60-40, at least over long periods of time, how should they kind of dynamically do things to take advantage of opportunities or reduce risk over time? So this chart right here kind of shows the usual 60-40. So of your 60% equities, 2/3 would be US equities, so 39% exposure there, and about 1/3 or 21% would be international. And then normally you'd be 40% bonds, that would be broken into 28% US, only 12% international. Now, because they're fairly bearish on US stocks, they've got this all the way down to 30% equities. And of those equities, a heavy weighting to US value and a pretty big underweight to US growth. And then the international markets is actually surprising to me, is also lower. So only about 8% to developed ex-US and only 2% to emerging markets. And that one really surprised me because emerging markets, valuation-wise, are some of the cheapest in the world. Now, on the fixed income side, so we've got heavy weightings to US ag bonds, decent weighting to international bonds, 21%. Again, this is a pretty big deviation from the way most investors' portfolios are allocated. For most people, their allocations are much closer to anywhere from, the lowest I typically see is something like 50% allocated to equities, and the highest is 100. I even see people in their mid to late 50s, even people in retirement, 100% equities. So how are they getting this? Why are they so bearish? So this is just based on their forecast. They come out with a 10-year forecast. A lot of these forecasts are basically being driven by current valuations. How expensive are things? So they think US equities are going to do something between 2.8 and 4.8% over the next decade. Those would be very, very, very poor returns, although not outside of the realm of possibility. I mean, we saw lower returns than that from 2000 to 2010. So that kind of stuff is out there. Ex-US, a little bit more optimistic, 4.9 to 6.9, but still, well below the 10% or so, I think that over long-term historical averages have shown. So not great. Their emerging markets, again, between 3.2 and 5.2, it was lower than I expected. You can see they think US value is going to do pretty good, between 5.3 and 7.3. But US growth, that's the real one they're bearish on, 1.3 to 3.3. If you look at some of the valuations, you're seeing stuff trading at 100, 200, 300 times sales, let alone times earnings. So that is where a lot of froth appears to be, although there's a lot of growth in that area at the moment too. But that is driving a lot of their bearishness. On the other hand, bond returns look pretty reasonable here. So for the US Ag Bond Index, they're thinking 3.8 to 4.8%. That's pretty solid. And in fact, at the upper end, that's supposed to do as good as the upside of US equities. So, I think their basic position is you can get all the upside in US equities over the next decade with little of the downside. You don't have to deal with the volatility. They've received a fair amount of pushback for their forecast. This is pretty far outside of the norm. So in a Fortune interview, Greg Davis, Vanguard's chief investment officer, in the interview said instead of being 60-40, he suggested being 40-60, 40% equities, 60% fixed income. And again, he was weighing pretty heavily on Vanguard's capital markets forecast, the one that we were just looking at. In the baseline 60-40, they've got about 2/3 of the portfolio US, 1/3 non-US. He thinks that should be more like 50-50. So if you're only 40% equities, Greg Davis was suggesting 20% US, 20% foreign. For most investors, that is a big shift from where they currently are. In fact, I was looking at like an AAII survey of the average investor allocation to equities, and it's about 70% right now. So that is near some of the high levels. So then the question is, do you agree with this? How should you respond to your portfolio, your asset allocation? I think there's really only two ways to go. For most people, you either just have a static, set it and forget it approach. You're saying the appropriate asset allocation for my risk tolerance and goals is 60-40, then 60-40 it is. You rebalance once a year or so and just never deviate. Doesn't matter if times are good, doesn't matter if times are bad. Just every year, reset it. The other option is to follow something like the TVAA and be more dynamic. Trim things when things have really run a lot, overweight things when they've done poorly, try to take advantage of either higher possible returns or potentially lower risk. Now, for most people, that's pretty challenging. Unless you're just going to follow that TVAA portfolio, your human psychology is working against you. People want to overweight what's done well recently. So right now, people want to overweight US equities, US growth, US tech, some of the scammy stocks too. That's the stuff that's done well. That's what feels good to overweight, but that is probably not the right approach to maximize long-term returns. Now, personally, I do actually try to follow a more dynamic asset allocation. If you look at US stock market valuations today, we are at some of the most expensive levels in history. As you see in this chart, you're going to see the US stock market on this composite evaluation metrics. It's the most expensive it has ever been. Every time you've hit these peaks historically, you've had massive drawdowns, pretty poor long-term future returns, and a ton of volatility to achieve those. My goal for clients is to try to minimize some of that downside. And I just think there's been more attractive things. People who are paying attention would know that international stocks, especially emerging markets, have done fantastic this year. So those who have already gone ex-US, a lot of people kind of scoff at these Vanguard things, say, well, why, look at how well the US market's done this year. This is terrible advice. But international markets have done great too in a lot of cases. Only time will tell. And frankly, even 1 year from now will not be enough time to tell. It's going to have to play out over 5, 7, 10 years. And I think for most people it is challenging because, again, you're just not plugged in enough. But interesting stuff out of Vanguard. If nothing else, make sure that you're not over your skis, that you haven't taken too much risk, that you have at least rebalanced in alignment with what your goals and risk tolerance are. Appreciate if you like this video, subscribe to my channel, and share with anyone you think would benefit.